Good afternoon, everyone. Hope everybody's doing well and enjoying or making the most of these fleeting days of 2024. It seems like December is skating by, getting close to the end of the year and the holidays. So hope everybody's getting through okay and having a good one so far. Thanks for joining us today for our fourth quarter 2024 review and our 2025 market outlook. My name is Mike Musio. I'm the president of FBB Capital Partners, and I'm joined again by my colleague Mike Bailey, who's our director of research and chair of our investment committee at FBB. And working behind the scenes, as always, is our friend Katie Bogley from Florida, helping us out today. So we'll have an opportunity here as we go through some initial thoughts on what's happening in the markets and what we're expecting to do some Q&A. If you take a look at the bottom of your screen now, you'll see that there is a chat feature right in the middle of the toolbar at the bottom. You can click on that. I'm sorry, not the chat. Next to the chat, a few over is the Q&A. You can click on the Q&A, type in your question, and that will actually push to me, and we can try to answer some of those real time. I'll take questions that have been submitted beforehand and those that are submitted on the fly, and I'll try to kind of aggregate similar questions together in the interest of time so we can hopefully answer as many questions as we're able. Finally, we will be recording the call today, which you may have heard at the top. So this will be available for a playback on the website probably tomorrow. As we begin today's discussion, let me remind you of the fact that today's commentary is based on the facts as we see them today, which of course are ever changing. Please note that any reproduction or transcription of statements made during the call without our prior approval is prohibited. Should you know someone who you think would like to listen in, again, it'll be up on the website probably tomorrow. You can direct them there. Please note that all forward-looking statements made during the call are subject to risk and uncertainty that could cause actual results to differ materially from the expectations and assumptions that we discussed today. And finally, please review our complete compliance statement and disclaimer at the end of the webcast, which we'll hang on the screen there for a moment as we start the Q&A. So with that, let's dig into it. Mike, it's been an interesting 2024, an interesting quarter, very interesting 5 or 6 weeks in terms of markets and macroeconomics. So let's dig into it, see where things stand today and what we're expecting for 25.
Absolutely. Thanks, Mike. And so, as Mike said, lots going on right now. So today we are planning to take a look at what's played out for most of 24 and look ahead to next year with a focus on some of the bullish investor sentiment that's been raising expectations for companies to produce earnings that are going to support some of those rising valuations. We'll also spend a little bit of time on developing policy changes for tariffs, taxes, interest rates, and deficits. And then we'll wrap up with our positioning and your questions. Next slide, please. So as we just mentioned, we are seeing investors start to ratchet up expectations for future growth. In fact, most of the stock price movement we've seen this year has come from bullish perceptions. There's frankly a smaller portion of the stock price movement coming from better sales or earnings. So as this excitement builds, it seems increasingly important for companies to deliver the goods. And we'll touch on some of these details later in the presentation. However, before we get to the economy and earnings, let's take a deeper dive and look at investor optimism, which has generally been moving in one direction this year. Next slide, please. Okay, so we just laid out a case for rising expectations for stocks. We are seeing that in higher valuations. However, there are other signs of a potential market bubble that are worth understanding. Within the broader stock market, a group of companies are riding the AI wave as they sell semiconductors, cloud computing, other types of AI software, even companies in data centers and power management. So we're seeing this group of companies in particular, they are meeting or exceeding investor expectations. We're seeing that at the moment. So that does suggest to us that if we're in an AI bubble, probably we have some more room to run. So we'll keep an eye on that. Beyond AI, we are seeing other speculative markets such as Bitcoin also reaching all-time highs. Certainly worth watching, and we'll touch on that in a poll question. However, on top of these trends, we're also seeing broader market volatility fall below average, signaling to us that investors are in a state of comfort or even complacency. Oftentimes, if we see some unexpected bad news when markets are moving slowly, we can get a jolt and markets can become volatile and react to the downside. So I promised to get to the other side of this argument in a minute, but before we go there, let's turn to the audience and see if you think we are in an overly hyped market, and we'll use Bitcoin as a proxy for investor sentiment. So with that, Mike, I'll turn it back to you for our first poll question on crypto. Mike?
Sure. We had a streak there through 2000, late 21 and through 2002 into 23 with no Bitcoin questions. And we figured with the run that it's had, we were just going to get out in front of it today. So poll question number one, I think we only have two of these today. Bitcoin is currently trading around 100,000 per coin. What's your best guess for where the price will be a year from now? A, 150,000 plus, B, around 100,000, C, 50,000 or less. Give folks a moment there. While we're filling that out, Mike, I mean, it's worth noting that on average, the market has a 14-15% correction each calendar year. And I think this year, to your point of lower volatility, the steepest correction we had was around 8.5%. So gives us a feel. All right, Katie. Pretty evenly mixed. 30, about a third of the folks think 150,000 or more, roughly a third around where it is today, and 40%, 42% think 50,000 or less. So that's what makes a market, Michael.
Absolutely. So, great feedback here from folks. I think it is interesting to see sort of a pretty divided response among you all in the audience. Perhaps that is a reminder that there is some speculation here. This isn't a type of market where there's a lot to frankly rely on as far as fundamental sales or profits or something like that. So there certainly are a lot of possibilities here. I saw a couple more votes on the downside. That's certainly possible with Bitcoin, especially with the pattern we've seen where you get big surges in crypto followed by some pretty big declines as sentiment moves away. So we'll keep an eye on that as we look ahead to next year. So kind of putting this in perspective as we put these thoughts in mind regarding a potential market bubble, let's go ahead and turn to kind of an alternative view of where markets are and investor sentiment and look ahead to next year. So next slide, please. Okay, so the one camp suggests maybe we're in a market bubble. The other camp sees things a little bit differently. Maybe stocks are okay. Let's explore that a little bit. Bears out there worried stocks are moving up too much. Bulls see the flip side. They frankly think you're getting more for your money when you're buying stocks. What does that really mean? If we take a look at some of the biggest components of the S&P 500 today, we see dozens of companies that are highly profitable with durable growth. And using this image as an example, each favorable quality for these companies acts as a column supporting broader market sentiment. So, for example, investors generally pay a premium for greater certainty. That could be part of what we're seeing here as stocks continue to march higher. And if you think about it, what would you pay for a car that breaks down a lot compared to one that's dependable? You could be seeing something like that going on in equity markets today. So let's go a little bit deeper and explain why and how this mix of companies is changing. Next slide, please. Okay, so we just made a case that the average company among U.S. large caps is getting better in terms of growth and profitability, but let's try to break that down. We can do that using this chart, which shows how the broader market has changed over the past decade. So back in 2014, about a third of stocks in the S&P 500 were in higher growth sectors such as tech, communications, services, which includes internet, and consumer discretionary. That also includes big e-commerce companies and electric vehicle companies. However, that portion of the market is now more than half, and that suggests to us that the basket of stocks you're buying now may be worth more than what we could have bought a decade ago. If that's the case, perhaps rising stock prices are more reasonable. And let's turn to the next slide now as we take a look at how investors are valuing this changing mix of stocks. Okay, so the chart here on slide 8 shows the historical price to earnings ratio for the S&P 500. What does that mean? That basically means how much investors are willing to pay for each dollar of earnings that these companies are producing. You might pay more for dependable growth companies and pay less for companies that have a spotty track record with mixed earnings results. Also, a higher PE level suggests investors are more optimistic. A lower number implies cautious sentiment. So let's take a look back, and we can look back at history and see, does that act as a guide for what's next? To be fair, some skeptics might argue that stocks were expensive in late 2021, and that was followed by a big downturn in 22. Could the same thing happen again heading into next year? Perhaps, but if we go back to this idea of a changing mix of stocks, we now have big companies generating incremental growth from AI, for example. These high growth and high valuation stocks are pushing up the overall average PE. So if these big high growth companies keep executing, we may have a better chance of additional upside. So in the context of another bull market, which we've seen for most of calendar 24, I'll turn it back to Mike Musio for our next poll question on market projections for calendar 25. Mike?
Thanks, Mike. So another wisdom of the crowd question here. S&P 500 is currently trading at around 6,100 or so here today. Where do you think the S&P will be at the end of 2025 compared to current levels? Up 20% or more, which would be, a 1,200 point move. Up 10 to 20%, which would be 600 to 1,200 points. 0 to 10%, which would be nothing to 600 points, and down 0 to 10%. And D, we can say down to any degree, maybe. Give folks a minute here. Okay, Katie. All right. So 2/3, almost 64% of folks say 0 to 10%, Mike. About 20% say 10% or more or anything higher, and then about 20% say down a bit. So I think that's probably tied into where, maybe a little bit counter to where sentiment is by the PE that we're talking about, but probably not outside of the realm of where our own thinking is.
Absolutely. So again, interesting feedback from everyone in the audience here. I think in general, that's pretty close to a mainstream view. I think if you go back and look at history, long-term stock returns are sort of with close to 10%, high single-digit 10%. It makes sense that next year could fall into that category. Interestingly, although the long-term stock results, you get close to 10%, or that's what we've seen. If you go year by year, a lot of times it's either way above or tends to be way below that. So it's just hard to know exactly how an individual 12-month period will play out. But again, going with history, that seems like a reasonable bet, especially after several strong years of 20% plus returns. So we'll see how that starts to play out. And I think, frankly, as we think through scenarios for next year, let's look at which camp could be right, bulls or bears. And so we'll turn to the next slide to see, frankly, where the rubber hits the road as we look at what's next. Okay, so going back to sort of the theme for today's presentation, it's earnings in the spotlight. And frankly, that's exactly what we think could make the difference for stocks as we get into next year. As expectations are rising, investors want to see if AI growth and tech companies can meet or exceed investor expectations. Historically, investors prefer to see rising earnings estimates, see the smiley face, rather than declines. So the question is really, what is in store for 2025? Overall, investors are expecting, or analysts out there are projecting about sort of low double-digit growth, kind of 12, 13% earnings growth. That is above historical averages, and that does probably feed back into why PE ranges or sentiment is above average also. Now, sort of taking a look at this chart, estimates have moved around a little bit in recent months, and we have seen some modest declines in estimates for next year's earnings, which is a bad sign. However, if you unpack that, some of the downside that we've seen comes from a particular group of companies in the energy sector, so maybe not quite as bad for the broader market. Our base case looking into next year is that companies have a reasonable chance to continue growing earnings in the high single-digit or perhaps low double-digit range, and especially as the economy continues to grow steadily and as tech and AI companies are finding new ways to expand their markets. So speaking of the broader economy, let's turn to the next slide and review some other factors that may impact companies and investors next year. Slide, please. Okay, so we've spent most of today's webinar taking a bottoms-up perspective on companies, earnings, and stock prices. However, the companies are operating in a changing economy, and that can influence growth and profitability. At the moment, we are seeing a pretty stable job market that gives workers the confidence to go out there and increase consumption, especially as we're seeing annual price increases around sort of 2 or 3%. And that's much lower than what we saw a couple of years ago. We're also seeing signs that in the short term, the Federal Reserve will continue to reduce interest rates as soon as next week. And we see that as gradually taking its foot off the brakes as it reduces constraints on the economy. However, there are other less certain factors on the horizon, especially as the incoming administration threatens things such as big new tariffs that could impact importers, consumers, and even inflation. There's a potential for trade tensions out there and other geopolitical conflicts that could impact commodity prices or global growth. And then back in the US, changes in tax policy or other things, even immigration or even Elon Musk's Department of Government Efficiency could impact annual budget deficits. So a lot of things going on. Plenty to unpack here. I'm sure we'll turn to some of this in more depth in the Q&A, but as a summary statement, we're generally sticking with a view of sort of slow and steady economic growth, and that allows companies to generate steady earnings. So as we continue to think about economic growth and especially inflation, let's turn to the fixed income market and spend a minute on bonds, which are generally linked to those two factors, growth and inflation. Next slide, please. Okay, so the chart here on slide 11 shows the yield on 10-year US Treasuries. We've seen this gradual slide down over time in yields, bottoming during the pandemic, with both inflation and economic growth at low single digits. However, as the economy and inflation have rebounded, rates are also back up, and that's offering bondholders attractive yields, which are likely above long-term inflation. However, as we continue to buy some of these long-term bonds for clients, we remain valuation sensitive, especially for corporate bonds. We're starting to get a little bit expensive compared to history. Although overall, we're comfortable with the types of corporate bonds available as we look to lock in relatively low-risk securities that can offset inflation for the long term. Speaking of the long term, let's switch back to equity markets and review our positioning and our strategic approach to investing in risk assets. Next slide, please. Right, so chart here on slide 12 shows historical stock prices for the S&P 500 in white, along with earnings in green. In general, we see stocks chasing earnings over multi-year periods, and we expect that pattern to hold as we look ahead and think about what's next. If we go back to today's theme of earnings in the spotlight, and we do expect corporate profits to have a significant impact on the direction of equities next year. And with that in mind, let's summarize some of our current positioning.
Sorry, just while we're on this slide, because I've got a question that's come in. So while we're on this slide, if we're expecting earnings growth of mid to or upper single digits, the tracking or thinking in terms of stocks following earnings, generally that's kind of an expectation, and of where prices might be or the market might be in 2025 as well, correct?
Absolutely. Yep. So you can see the two lines here. They bounce around, but they tend to follow each other. So over long periods of time, let's say over 10 or 20 years, if earnings are growing 6, 7, 8%, something like that, stocks tend to track that, maybe go a little bit faster. You can also throw dividends in there as far as the total return. But yes, as we think about next year, Wall Street is projecting sort of 12, 13% earnings growth. If that happens, and if stocks directly track that, you would expect stocks to be up, again, kind of low double digits. Who knows, a lot of times you do get a little bit of compression in earnings estimates. So maybe it's not 12 or 13, maybe it's 9, 10, 11. Again, stocks may continue to track that. And if that does happen, again, there's a chance that stocks would also be up sort of around 10% next year. That's a good question. Right. Again, helpful to sort of think through the short term, but also the long term here as far as earnings and stock prices. And I think as we sort of look at that as one part of our positioning, let's turn to the next slide as we look across all the different asset classes. Great. So we've touched on stocks and bonds so far today. We'll start with bonds. We continue to see corporates and treasuries as attracting or offering attractive ways for offsetting inflation. For stocks, we still see faster growth in the US, although we're focusing more heavily on valuation as broader markets continue to get more expensive. Our preferred way to deal with some of these concerns over market bubble is by identifying companies that can meet or exceed investor expectations, specifically on earnings, and going back to that theme for this presentation. Additionally, with lots of uncertainty on the horizon and stock prices creeping up, it can be tempting to think about moving away from stocks and moving towards cash as a way to try to time the market. However, our experience suggests that remaining fully invested tends to be a way to drive better performance, as opposed to trying to make two good decisions, getting out and getting back into the market at the right time. So let's tie this positioning back to our broader views with some concluding comments on the next slide. Right, so as we head into the holidays here and look towards a new year for markets, we generally expect modest economic growth. The key for us, again, we've hit on this several times, is earnings. We're delivering on what investors are increasingly demanding. Despite changes in valuation and potentially both upside and downside risks, we favor being fully invested in stocks and bonds as well, and particular securities that are offering total returns that can offset inflation and help to compound wealth. So with that, thank you for joining us for some prepared remarks, and we're happy to turn it over to your questions. Mike?
Great. Thanks, Mike. So again, you see the Q&A bubble at the bottom of the screen there, right in the middle of your toolbar on the bottom of the Zoom window. Feel free to pull that up, type in some questions, and we will try to get to them all. All right, I think this is a good question on both kind of the title of this webinar, Mike, which is kind of looking back at 2024 in terms of a review, and then market outlook for 25. So what would you say is one of the most significant takeaway from our 2024 investment or allocation strategy, and how that maybe what did well there, or right, or what didn't, and how that may influence how we approach capital allocation for clients in 2025? It's a great question.
A great question. The year's not over yet, but we're pretty close to the end. I think the question is, what have we learned? We've come through another year. Certainly, it's been a pretty big bull market. Things generally going well, but there are always ways to look at, what did you do? What could you have done better? What would you do differently next time? I think in some ways what we've seen this year and frankly in other years, some stocks where they've done great in some years and other times they've struggled. In particular, we've seen some companies tend to be smaller holdings. If they have one problem, a lot of times that's explainable. If we've seen 2 or 3 situations in a row where a company is missing or disappointing, that can be just a signal to say, you know what, let's walk away and invest in something else. So that idea of some folks sort of watering your weeds, stocks that just aren't working that well. And the flip side would be sort of cutting your flowers. Is there a stock that's working well that you decide to trim? But at the same time, you're holding on to something. Maybe the stock is looking cheap, but it's probably something worth moving away from. So I think we try to be open-minded. We're looking for continuous improvement. Learned a few things certainly from calendar 24. We hope to apply that as we're approaching 2025 and looking at our allocations.
Great, thank you, Mike. George asks, what can we learn from Trump's previous presidency? Are the conditions the same that it could be predictive? What would be the impact on tariffs on earnings? So Mike, I'm going to break this into 2 parts, and I'm going to take the first one and then give you the tariffs question. I've said this on a couple occasions with clients. The setup is not the same for 2025, 24 election in 2025 as it was in 16 and 17. When Trump won in 2016, we had just ended a period of time where stock prices had not moved basically for the prior 2 years. We were in an earnings recession in the S&P from mid 2014 to middle end of 2016, where earnings did not grow and stock prices did not go up. And because of that chart that Mike showed of stocks following earnings, the multiple on the market at the time was more along an average type of valuation, 16, 17 times earnings. So the setup from that perspective was, improvement, tax cuts where corporate rates, fell by 30% or more in some cases, was a setup for a nice bump, the Trump bump from election day to inauguration day that continued for all of 2017, which that year ended up with a 3 handle, 30+%. That was pretty attractive. Fast forward to today, the last 24 months, remember 2022 was a down year for markets, both stock and bond markets. The setup from October of 22 to November of 24 was you have a period where equity markets were up 40+% in the trailing 2 years, and valuations are also up. And back to that earnings chart, we're looking at 22, 23 times, forward earnings estimates, which is stretched by any kind of historical definition. So I don't think, George, that the market setup is necessarily predictive. Some of the policies, on the other hand, may be. And so, Mike, I'll let you talk about tariffs for a minute.
Yeah, absolutely. So, tariffs, we put that on one of our slides in terms of things on the horizon. What are risk factors? What could change into next year? Things could go either way, frankly. I guess a couple of things to point out. On one hand, you could argue, well, this isn't our first rodeo. We had Trump 1.0, a lot of uncertainty around tariffs, and stocks did okay. Companies, we survived. There was no major recession triggered by tariffs, et cetera. So we could say, well, we've been there, done that. We can manage it. Some other things I think on the positive side would be companies have sort of figured this out. They've lived through tariffs. That wasn't fun. They lived through COVID. They lived through the supply chain pressures that we saw coming out of COVID. A lot of companies have diversified their supply chains. And so if, for example, a company in 2015 had 100% of its product coming from China, a lot of companies are really spreading that out. So that does manage some of that risk. The flip side here on the maybe on more negative is we are seeing some bigger numbers coming out of the new administration. So bigger tariffs, and it seems like potentially applied towards all kinds of countries out there. So that certainly could be a risk factor. Although again, we're really going to have to see. There's probably some back and forth here where this could be a negotiating tactic, if you will, and perhaps Trump is saying one thing and hoping for other countries to meet him in the middle, et cetera. So it is certainly a risk factor. I would throw that within geopolitics. But again, we sort of been through one round of this. I think companies are developing ways to manage through. And I think that's kind of our general approach.
Great. Thanks, Mike. We'll take another question here. And as I said again, feel free to pop a question in the Q&A at the bottom of the window there. Combining a couple questions here that are similar from Tim and Max. What's your take on the incoming administration and more broadly crypto? So kind of a follow-on from that first question we had, Mike.
Absolutely. So we've seen crypto moving a lot. I do think part of that could be investors watching the election results, seeing things that Trump has talked about, and maybe hoping for something to be a little bit different and maybe helping out the crypto asset class. So that is certainly something that we are seeing. I think in terms of other things that other perspectives to apply other than changes in regulations, just looking at crypto compared to other asset classes, we still view it as fairly speculative. And as we compare crypto to other things that you can buy, stocks or bonds, et cetera, really, as you think about fundamentals, if you look at a company, you're trying to evaluate a bond or a stock, there are sales, there are balance sheet, there are profits there that you can take a look at and sort of hang your hat on. Crypto is a little bit different, and so we do have some concerns there. Again, going back to the poll question, a lot of folks, frankly, don't have much of an idea where that's going to play out. We can pivot back to stocks. We sort of showed a chart suggesting stocks chase earnings. Really don't have much of a track record there with crypto. So certainly we could see some different things happening with the new administration. We're going to continue to evaluate the way that plays out. But certainly we continue to view the asset class as fairly speculative.
All right. Thanks, Mike. Combining a couple things here. Given the Republican sweep, what sectors, if any, are we pre-positioning? Maybe expecting a policy shift, and I'll kind of combine that in terms of compelling investment opportunities for capital deployment in 2025. So there's a lot of this in terms of what based on a regulatory or decreased regulatory environment. I'll read into this a little bit, Mike, might be compelling. Maybe spend a minute talking about financials and whatnot, and then I'll speak about fixed income on the back end of that.
Sounds great. So get some good questions there. There are plenty of opportunities out there in the market for us. I think as we get political changes in administration, potential changes to regulations, we have to be aware of all those things. They can impact companies we own, and they can open up opportunities for new companies we're not looking at to have some compelling growth. I think, though, for us, we want to make sure we understand, upside potential and downside risk. And so if there is something that's speculative, let's say, for example, the new administration is looking at potential changes in regulation on some company or some industry, then the question is, are you going to bet on that? You're going to make a political bet and get into that in a big way, knowing there's upside and downside. So we do evaluate those things. Sometimes there can be potential. Sort of there's a managed amount of risk, or let's say there's minimal downside. But a lot of times it can be almost binary. If you bet wrong, if policy goes against you, that can be pretty challenging. So that is something that we do try to weigh. I think maybe going a little bit deeper into some of the question here, in terms of sector weightings, are there particular sectors you might want to overweight or underweight? Mike Missy mentioned it a minute ago. Financials is one. We've been overweight financials for some time. But we still like that area. Insurance is a big part of what we own on the equity side. There's a lot of good things happening there, a lot of durable growth and reasonable valuations. So we do like that. Other sectors where we've made a bet and we're evaluating that, communication services, we've got sort of a low weight there, primarily based on social media. We like Google. It's an attractive company. We're looking at other things in that space. But at the moment, unlikely to make any major changes. But again, you do get unexpected things happen, valuations change, companies change, and we're certainly aware of that and prepared to make changes as needed.
Okay. The crypto answer lodged a couple other questions here. So combining a couple questions here from Steve and Lou. Based on your comments on it being speculative, is the point that it's off the table at this time, or not investable from our standpoint at this time? And maybe as you prepare to answer that, I will say the structure to be able to invest in crypto has improved since we held this year-end seminar last year, and that so much as the actual ETF structure is available. So, and as you would expect, something that started with very minimal assets at BlackRock is approaching $50 billion in capital today. So there is an ETF out there that's a little bit more investable from our perspective. But yes, we do see it as a speculative asset, and at this time, does not have a place in client portfolios. It doesn't mean we don't look at it. We don't, particularly as a read for where risk on, risk off is. You've got an asset class that's corrected, more than 80%, I think, on 3 different occasions in the last 7 years, from a price standpoint. So we follow it for that reason and others. So never say never from my perspective, but not now from FBB's standpoint. Mike, I don't know if you have anything to add there.
Yeah, no, I agree. The only thing I might add is sometimes for some of these speculative asset classes, there are kind of diversified ways to approach it. So let's say there's a payments company where crypto is a small part of that. So you could own a company that had several lines of business, and one of those could be some kind of transaction involving crypto. So you get some exposure. It's through a real company, but the risk is kind of managed. So that's not something we're doing currently, but we're open to. Again, we have to be aware of all the asset classes out there as they're changing, and if something does become compelling, we'll take a look at it. But again, at the moment, really, it seems like we're getting more attractive returns elsewhere.
Okay, SFS, do you still advocate a 60/40 mix in general? Also, do you think a higher percentage of the portfolio should maybe be moved into TIPS, which are Treasury inflation protected securities on the fixed income side of things? Now I'll kick that off. 2 years ago, at the bottom of the correction in 2022, when bonds were down, I think at that point 16 or 17% in September of 22, and stocks were down 25%. The 60/40 portfolio was down in the first 9 months of 2022, more than it was down for the entire year of 2008. And every headline above the fold or in every magazine was the death of the 60/40 portfolio. And 2 years on, the 60/40 portfolio has ripped and raged back. So I would say in general, again, that's a good starting point. It's not a one size fits all. It depends on your time frame. It depends on what your real risk tolerance is. Remember, the 3 pillars of risk for FBB are a client's ability, need, and willingness to take risk. And that comes into measuring what an appropriate allocation is for a client. I will say the mix of the 60/40 mix is changing a little bit. And maybe Mike, just talk about stocks, bonds, and then what a potential alternative sleeve might look like.
Yeah, absolutely. Would agree with just everything sort of starting out with 60/40, and it tends to be a pretty good fit for a lot of clients. So historically, it's been fairly black and white, 60% stocks, 40% bonds. Within that bond sleeve, maybe some cash. We sort of took questions on crypto as kind of this developing asset class. Another asset class that's out there that we're sort of dipping our toe in a little bit is alternatives. And so what does that mean? It tends to be private markets or private assets that don't trade on an exchange. It can be private credit, which is similar to on the bond side, private equity, closer to an equity type of return. There are infrastructure companies out there that's sort of non-traded. So these are some areas that we're looking at where you can sort of maintain generally a 60/40 exposure. However, within your 60% equities, maybe you can have a small amount of private equity, for example. On the fixed income side, maybe you've got some private credit. So these are some things we're looking at. Certainly early days for us. Every client may have a slightly different looking portfolio, but there certainly are some other asset classes out there that may make a fit within that 60/40 construct. It may look a little bit different than something folks looked at 10 or 20 years ago, but I think it is something that can help folks out on one hand, 40%-ish of your portfolio generating nice income. The other 60, that's where you take risk. And so I think as you sort of think of those as your lower risk and higher risk categories, that's something we'd like to continue working on.
Great. Thanks, Mike. Rita asks, do you think AI excitement has died down in terms of stock prices of various chip companies?
Yeah, so it depends, but certainly the excitement over AI, it comes and goes. I think certainly we're in a pretty good shape now as far as sentiment. I don't know if we're at peak. That's again, we're maybe off the peak a little bit, but if the big bang here for the latest round of AI was about 2 years ago, is when ChatGPT really kind of came out and made a big splash. We've seen a few companies do incredibly well. We've seen some bigger tech companies have exposure to AI, whether it's Amazon, Microsoft, Google, et cetera, doing very well. Those companies are still doing pretty well. And you look at broader markets, frankly, near all-time highs. So I do think sentiment is pretty good for AI. And that frankly feeds back into the theme of everything we're talking about here. The expectations continue to rise. However, companies really are finding a way to generally meet those expectations. So every quarter is going to be very critical. We're going to get another set of numbers kind of late January, early February. And we'll find out, our companies, they're going out there, they're growing, they're expanding their markets. AI is a big part of that. And we'll see if they can continue to match those rising expectations.
We got a couple of questions around kind of going back to potential, policy. Let's see. I guess I'll ask these as distinct separate questions. Warren asks, areas of the market that may be negatively affected by potential immigration policy. Mike, any quick hits there?
Yep, absolutely. So immigration, if there are restrictions on that, certainly you could think about parts of the economy where they tend to hire folks who could be immigrants. It tends to be service types of industries. I think as investors, a lot of the companies that we own, many of them are bigger manufacturing type companies, and there's less of exposure to that part of the economy. So we're a little less worried about that from sort of a stock picking perspective. However, if you do get lower immigration, if that leads to kind of this chase for workers, and that pushes up wages and that leads to inflation, that certainly can have a feedback loop and add some pressure. So it is certainly a factor, but I think at the moment it's probably not at the top of our list in terms of risk factors for companies in the own.
Okay, sticking with policy, given next administration's policies around insurance, Social Security, what do you see the impact on the market being? Maybe I'll take this one, Mike. So Social Security changes unlikely for anybody who's currently, and by the way, like all of this conversation about any kind of belt tightening, none of it took place in the campaign. It's all been post campaign, post election discussion of Doge and whatnot. But unlikely to be changes to Social Security to people that are already collecting, even unlikely for people who are already in their 50s from an age standpoint. I would say, and I've said for many years, like the most obvious thing on Social Security, there's three things. One is moving up gradually the retirement age. They've done that in the past. I don't think that would affect existing clients of FBB who are at retirement age. So gradually moving up the retirement age, sliding the scale of income that Social Security is paid on. That is naturally slides every year anyway. We do not any longer, since the advent of Obamacare, scale or stop the scale for Medicare payments. So it seems reasonable and rational to not cap the Social Security payments at $170,000 or whatever it is of income and scale that up to something more. And then the final point is cost of living adjustment, specifically with Social Security, is something that has changed over time. So it would not surprise me if that would potentially be on the table if those discussions get that deep. I personally don't think they will. I don't think anybody wants to touch, Social Security. Unfortunately, there's some things there that, could fix that. Medicare is tougher. Medicaid is the toughest. And so that's probably the order of, operations if those discussions get that deep. Okay, what impact, Mike, do you think that antitrust efforts might have on companies like Alphabet or Microsoft?
Great question. So there's a couple things, kind of baked into that. I think one is, what is happening right now. There's a lot of antitrust policies that are out there and litigation, et cetera. However, the administration is changing. I think the question is, could a new administration treat that differently? It's possible. So it's really hard to say. There's a lot kind of going on there, some complexity with some of these deals. If you look at history, it does seem that it's pretty unusual to have a big, antitrust result in particular that breaks up a company. Really haven't seen that in a long time. And I think companies, Google, Amazon, Apple, and others, they've seen what Microsoft went through for years and sort of figured out a way to manage things along those lines. So we'll see. Anything's possible. Some who are kind of bullish on, let's say, Google, for example, that have suggested if there's a breakup for some of these companies, the pieces might be worth more separately than they are together. So certainly, from the investor perspective, there could be some upside or at least a neutral outcome. So lots happening out there, but I think at this point it's a little too early to kind of speculate in terms of the final outcome.
Right. Final question here, Mike, from Brian. We're looking at alternative investments like private equity, private credit. What level of illiquidity premium are you aiming for? Additionally, what's the primary objective behind pursuing alts? Is it portfolio diversification or return enhancement? Brian, the answer is yes, to the last part of your question. It's both diversification and return enhancement. Illiquidity premium, for example, on something like, for example, in the private credit markets where treasuries are 4.3% today, corporates maybe 4.8 to 5%. Liquid private credit is in the upper single to lower double digits. So that I think gives you an idea of that, at least on the credit side. Mike, do you have anything to add on the equity side?
Yeah, I mean, I think you could kind of just crank that up a notch. So if public equities in long-term returns around 10%, kind of 9, 10, some of the private equity sort of strategies out there are looking at low double digit up to kind of mid-teens type of returns. Again, you are taking on some risk there. There's liquidities or a lot of other things to think about, but those are some of the opportunities that we're looking at for those sort of private markets.
All right, great. That's all the questions we have today. Again, I want to thank everybody for tuning in. Should you have any questions about how your specific portfolio is positioning going into 2025 and want to talk to your portfolio manager, we absolutely encourage you to do that. Also a reminder, the one date that does not get moved on the calendar is December 31st. So if there was any kind of, or is any end of year like tax planning, distribution planning, gifting, et cetera, that we haven't already talked about that you think we should be, call your portfolio manager today and start that process if it hasn't happened already. I think most of that's run through now. And then finally, at FBB Capital, we've had a good year. We've been able to add some team members to help with both the wealth management side of the business and the customer service side of the business and the research side of the business. And we couldn't do that without the continued trust and support and loyalty of you all as our clients. We very much appreciate that continued trust and confidence that you have in the firm. And as you're gathering with friends and loved ones around the holidays and having discussions about markets in 2025, and you think that they could benefit from a conversation with us, we would give that our highest priority and appreciate you always thinking of us. Thank you very much. We appreciate you. Happy holidays, Merry Christmas, Happy New Year's, and we will see you in 2025. Thank you all very much. Thank you, Mike.
Thank you.